Chamath Palihapitiya announcing here on halftime his latest special acquisition company will merge with the popular fintech firm SoFi. You know that well. And take that company public. There's Chamath. He joins us now. Congrats. Welcome.
Hey, Scott. How are you?
I'm good, thanks.
Happy New Year.
I know you as well. And I know it's a big day for you. Why SoFi? Have you been targeting fintech for a while? How did this come together?
Yeah, a lot of the things that I do is try to look back at some of the best investments we've made, like Amazon and Tesla, and try to find patterns. And in this, what I was trying to do was map those patterns into financial services, just because we're at a point in time where it's clear that the banking infrastructure really isn't meeting the needs of U.S. consumers. And so what I did was just kind of systematically try to figure out what was broken in banking, and then try to figure out which company was best representative of the solution that people wanted, which I can basically tell you is three things. People want low to no fees, they want fair and transparent lending, and they want a full suite of products so that you can basically have a one-stop shop. And SoFi basically was the top of the list when I looked across all the companies on those dimensions.
We've obviously been following SoFi for a long time. It's been a member of CNBC's Disruptor 50 list, so we're very familiar with it. We're familiar, obviously, with Anthony Noto. The idea of this disruptive force, Chamath, in banking post-financial crisis and what people are looking for, that's a big part of the success of SoFi. And certainly of your attraction to it.
Yeah, in fact, the way that I think about this is I call this sort of the anatomy of innovation, right? You look under the hood of the best companies and the best CEOs, they do the following things. The first thing is when you get a good product, you don't sit on your heels. You double down and you invest really aggressively to use technology to drive down the cost. And then what you do is you deliver those savings onto consumers. Then you launch many more products on top of the same platform. And the most important thing you have to do for people is to democratize access to a key resource. That's what Amazon has done. That's what SoFi is doing. Because the problem that banks have right now is after the great financial crisis, what they've done is they make money with hidden fees, with exorbitant fees. They have very restrictive lending practices. Ask anybody who's a middle-income person or a minority or a woman. It's incredibly hard to get access to the money you need to fulfill your dreams. And SoFi has fixed all these things, which is why I think it's such an incredible business.
How did you convince Anthony Noto that you were the right sponsor to be the one to make it all come to fruition?
So, the thing that Anthony has done, which is incredible, is he's basically created, again, as I said, this one-stop shop that gets, your money right? A whole suite of products. And the thing is, a lot of what I've done in the past and what my team has done is really help people operationally improve how they grow, how they market, how they can virally expand. And all of these dynamics, I think, came to play because when you look under the hood at SoFi, there's this incredible thing happening. You have these millions of customers, 1.8 million last year, 3 million members this year, but then they are paying for millions and millions of products. And so what we saw were these dynamics where there was this incredible upselling and cross-selling behavior. And what I talked to Anthony about was, can I help? Can I try to do what I've been able to do at Facebook, what I was able to do at Slack? In fact, when Anthony and I first met 10 years ago, it was actually when he was at Twitter, and we talked about working together there to do the same things. And so that's how the relationship started, and that's how we decided to come together and do this transaction.
What is it about Anthony that is attractive? And can you just speak in general to that idea of the importance of the person who's actually running these companies? Because, not all SPACs are created equal. They're not a guaranteed success. You have to rely on the person who's founded this company. You're the investor.
Look, I think you're seeing, even through the events of the last 24 hours, leadership and character really matter because you are faced with incredibly difficult decisions of policy, of morality, all kinds of things. Here's what I can tell you just personally about Anthony. He has lived an incredibly hard life to get to where he has. And I have tremendous empathy for that because I've lived a similar path. And so I just have deep respect for the man that he is and the character that he has. But then, practically speaking in his career, he is just completely money in the bank. I mean, the former CFO of the NFL, the former CFO of Twitter, the former COO of Twitter, an incredible banker, a great research analyst, and just a wonderful human being. So this is sort of a what you see is what you get kind of guy who really believes in advancing financial services for, middle America, for normal folks to be able to sort of get ahead. And I just think that that's a person you want to see win. And then as a result, the company that he's built is just really special.
Yeah.
Welcome back to the channel, everyone. Hope you enjoyed that clip from CNBC there where Chamath breaks down his latest SPAC merger with SoFi. It gives us a good idea as to why he sees SoFi as a great investment opportunity. We're going to jump into the investment thesis that Chamath gave us, as well as discuss our own thesis. I'm going to break down the numbers for you to see what sort of valuation might be reasonable for this SPAC. Firstly, though, I'll just give you some quick background on Chamath, and hopefully it will give you some confidence in his beliefs and investments. Okay, so who is Chamath Palihapitiya and why should we listen to him? So Chamath is what brands himself a social capitalist who invests in companies for the future or of the future. He was an early employee of Facebook, played a vital role in growing the company in its early stages. He is also the founder of Social Capital and openly talks about his ambition to build the modern-day Berkshire Hathaway. He has been active in the public markets recently with SPAC deals such as Clover Health, Open Door, and most notably Virgin Galactic, which he remains chairman of. All of these IPOs have managed to soar since the original public offering or original SPAC merger, meaning his track record really speaks for itself. He also mentioned on Twitter that he's achieved himself a 35% compound annual return over the past 5 to 10 years, although this is not publicly disclosed and it's coming from him, so it should be taken with a pinch of salt. It's also his refreshing take on investing and the capitalist status quo that has made him very popular throughout the masses. Both of these factors combined have made him, to many people, an appealing choice of partner to invest with, which is essentially what you're doing when purchasing his SPAC before a merger has been announced. He has said he is doing the SPACs to help individual investors get access to some of the best private companies of the future, as the old method of IPO very much favours the institutional investor. His latest SPAC merger, as we just saw, was announced, and his SPAC IPOE will merge with fintech company SoFi, short for social finance. The announcement was obviously well received by investors as the IPOE stock, soon to be SoFi, I'd imagine, soared 69%. The deal would value SoFi originally at $6 billion. However, the merger hasn't actually gone through yet, so there is some chance that the terms could be changed. But if we go by the current stock price for IPOE, it's valuing SoFi at $20 billion. And this is because IPOE shareholders will own 9.3% of SoFi once the merger happens and the company goes public. IPOE's current market cap is 1.8 or around 1.8 billion. You divide that by the 9.3% ownership it will have in the company, and that gives you the market cap for SoFi, or valuation for SoFi, through purchasing the SPAC of $20 billion. Now, we're going to do some analysis shortly on SoFi and a small amount of information that we do have, as well as go over Chamath's investment thesis and see if we can make sense of it all. Firstly, let's discuss SoFi and what it is. So SoFi's mission as a company is very simple. They want to provide individuals with the resources to build financial freedom, which I like. And it should resonate really with everyone watching this channel, as the reason we're doing all of this, I hope, is to build an investment portfolio maybe that helps push us towards financial freedom. Now, not everyone is looking at financial freedom as building an alpha generating portfolio. For others, it may mean being debt-free or having adequate savings for a rainy day, or saving and preparing for retirement if you're a little bit later in your life, or even starting early. Obviously, this opens up the doors for SoFi as they cover all of these needs to a much wider customer base and a wider market, as almost everyone tackles these issues at one point in their life, unless you're born into great wealth, obviously. If we look at SoFi's products and what it actually offers, or maybe its core product, so it's an all-round app. And I will just say this obviously isn't available in the UK, so I don't actually have experience using the product. I'm just going off of what I can see on their website. It's an all-round app that allows you to purchase stocks, ETF, crypto, basically invest commission and fee free, which is great. But obviously there is a lot of companies and a lot of other apps that have made this move too. You have Robinhood, you've got Trading 212 in the UK. and many others as well. You can also apply for loans, personal loans, refinancing, student loans, credit cards, mortgages, as well as sort of having it act as a savings account with the ability to store money in there. They also give you access, which is interesting, to financial planning consultants and advice at no cost, which is very interesting, I must say, but I'd like to know more about how the economics of that work for SoFi. Surely this creates a great cost for them. But anyway, it's good to know, and it's another resource to add to SoFi's list that it's likely competition do not have. All that I just mentioned, as I said, is done through one individual app, which makes it in terms of ease of use very attractive to customers looking for that sort of thing. They're obviously absolutely fee-free and only charge customers interest if it's due. A lot of traditional banks and lenders obviously charge hidden fees, not always, but the majority of the time. So they're a disruptor in that sense. And as we heard Chamath say in the interview, that is a big part of why he feels they will succeed into the future and disrupt those legacy companies. SoFi's CEO Chamath mentioned the ability of Anthony Noto in the CNBC clip. He has quite an impressive background, I must say. I don't know much about him, but someone, like Chamath, if they're very fond of you, then in my eyes, he must be an impressive character. But recently, he was at Twitter as COO. He has experience at Goldman as a co-head of investment banking and also CFO at the NFL. So quite an impressive CV, to be honest with you. Okay, now we've covered what SoFi is, its product, its mission, it's partly covered its management. There obviously is a lot more to it, and we could go more in depth, but I want to make this video fairly short if I can. Let's look at the investment thesis and the numbers to see if we can make sense of this merger and valuation. So how I would summarize Chamath's investment thesis here is really, he's looking at banking and personal finance, and he touched on this in the interview. He's trying to build on the type of investments he made in Tesla and others and sort of look at what industry was next. And it looks like he landed on banking and personal finance, and he sees it as a market that is ripe for disruption. He states how traditional banks up here have been hamstrung coming out of the financial crisis, therefore stuck in the mud when it comes to meeting the ever-increasing demand of customers. They are behind on technology and innovation in a massive way, but can't take measures to keep up due to the importance of meeting short-term ROE requirements and of shareholders and regulatory requirements for adequate capital reserves. He thinks it's time for new entrants with no legacy issues to take the stage, and he is betting the high expectations and demand of customers, I'm assuming younger generations, to force a mass migration over time from legacy products to new innovative products and solutions, of which he lists the below, which SoFi obviously offers under one app. He does mention the avid spending in the space, which I wasn't sure helps the cause at first, as it shows how saturated the market could get in a few years unless there is one clear winner. And a saturated market obviously leads to lower returns on capital, and we've seen that in the financial space before. However, there are two things in the qualitative part of the investment thesis that actually subrogate my feelings towards that saturated market issue. Firstly, he believes SoFi offers a best-in-class solution to the digital finance dilemma. He mentioned some numbers to back this statement up. Now, 56,000 ratings in the App Store, which is obviously their product via the app. The average around 4.8 stars, so almost perfect. And 1.8 million members that are expected to grow to 3 million in 2021. Now that is impressive customer growth and tells you a story in of itself. We'll look into that in more detail in a moment. Of course, these stats don't actually tell us much about the potential competition, which is what I'd be more concerned about over time if that market does get saturated. But this part really interested me. Secondly, he tells us SoFi offers the leading infrastructure platform for other fintech companies in this space. He goes so far to call it the AWS of fintech, which is a very big statement. The point is, if this is true, SoFi would actually benefit greatly from a saturated market of fintech startups, given they provide the infrastructure for them. I also don't know what the contribution is to profit and revenue for this part of the business. We may look at that later in the numbers, so I wouldn't get too carried away, but it definitely does subrogate my feelings, like I said, towards that saturated market issue, if they can be a bigger part of that saturated market. Okay, lastly, just before we look at some of the growth and numbers ourselves, let's cover Chamath's quantitative thesis for buying SoFi. He covers how their business model is reliant not just on vertical customer growth, but horizontal growth as well. And much like Lemonade Insurance, which we covered in a video before, they also had a business model that relied on customers purchasing multiple products from Lemonade to help increase contribution margins. As their greatest cost, as with most tech businesses, was the initial acquisition of a customer or the initial sale. We also saw something similar with Palantir as well. It looks like the same goes for SoFi, which, as we can see, they offer low-cost digital solutions to customers. If every customer only used one product, the margins probably wouldn't work. Customers buying multiple products produces rapid growth numbers, however, and high contribution margins, Chamath says, as the acquisition cost, I'm guessing, is zero. Again, he gives us some numbers demonstrating SoFi's ability to cross-sell. So we've got 65% of all home loan sales came from upsells to existing members. So 65% were made off of cross-sales. Pretty impressive. 24% of all new product sales that is, came from existing members. So, you're looking at a quarter of all the sales, I'm guessing in last year, come from existing members, which is quite impressive and shows that they do have the ability to cross-sell. But I think I'd like to see that number, go up as time goes on, that 24%, but it is still a good number. Now, I'll look at the growth expectation quickly, which he gives us. Revenue is expected to grow at a compounded rate of 43% over the next 5 years, and that is fantastic growth. If they can actually do that, it's very impressive. I must say, if they do, you can expect euphoria in the public markets for sure. The markets react very well to growth, even sort of high double-digit growth, let alone 43% compounded on a consistent basis. This gets us to 2025 expected revenue of $3.7 billion or $3.67 billion, which is a very, very good number, I must say. They're also expected to be profitable as quickly as next year, which is great to see. EBITDA, although adjusted EBITDA, I'd have to dig into what that adjustment is expected to reach $1.17 billion by 2025, which means they would have an EBITDA margin of 32%, or they're targeting a margin and think they're capable of that, which hints at a very, very profitable company, I must say. Now, SoFi was founded in 2011, so it's not exactly a new startup. It definitely has a proven track record of being a successful and growing company that's able to attract customers and retain customers. So we haven't really got that new startup risk there. Chamath also lists the valuations investors would be essentially buying SoFi at by buying the SPAC at its original price. So we've got off of an enterprise value of 6.5 billion. He's saying that we have a 6.7 times EV to revenue in 2021 and a 1.8 times 2025 EV to revenue in 2025, which, don't get me wrong, are very, very good multiples. Also says 13.6 PE ratio if you're looking at 2025 expected earnings, which, again, great multiples to buy a company like this at, especially when they're growing as fast as 43%. However, the valuation for SoFi has obviously changed. It's now 20 billion, as we covered earlier. So the new valuation metrics, if we're looking at forward earnings, are actually 20 times 2021 expected revenue and 5 times 2025 expected revenue, which is still good multiples to buy at. I've got some relative valuations here for, say, Palantir's 42 times current sales, Lemonade 87, Snowflake 164, Airbnb 19 times, DoorDash 58 times. So, when you look at those metrics there, it doesn't look too bad for a company growing top line at 43%. Okay, obviously 20 times next year's revenue and 32 times current revenue sounds like a very steep multiple to pay. However, we have to remember that a company growing at 43% year over year obviously warrants a high multiple. That growth rate, soon enough, in actually very little time, will bring that multiple down dramatically, just like we saw in the thesis from Chamath. So using an example, if we look at 2025, which is a sensible holding period for a stock like this, so 5 years, we could see SoFi potentially having a market value of anywhere from 50 billion to 80 billion. And I think it's most likely to sit around this 69 billion or 70 billion estimate if all goes to plan. And I'm measuring on a relative basis for the fintech industry in SoFi's 2025 financials. I'm using PayPal, Square, MasterCard and Visa as comparable public companies to get a rough valuation for SoFi in 2025. So if we look at what they're selling for at the moment, you've got around 14 times for PayPal and Square. This is price to sales. But obviously they haven't got the same sort of margins as MasterCard and Visa, so they don't get as high a multiple to sales. MasterCard and Visa, 22 to 24, but really high margins, 60%. So we can see SoFi are expected to be somewhere in the middle with their margin. Probably fair to say you could expect their price to sales ratio to be somewhere in the middle. And I wouldn't be surprised if it's selling for 19 times, if it's been growing at 40% or anywhere near that for the past 5 years. It may even have a higher multiple than this in 2025. So if we take that as our multiple or expected multiple against the revenue they're expecting in 2025 of 3.6 billion, then we get a market cap of 69 billion, which is obviously a triple from the price that you're paying today for SoFi. So, that's over a 25% compounded annual return if you held that for 5 years. Quite a bit over that. However, obviously nobody can predict the future, not even Chamath. So we have to really believe that they can achieve the numbers that they've predicted and continue being a leader in fintech innovation. And to be honest with you, the financials do look very impressive. The valuation looks impressive when compared to some of the other companies that have gone public. And we've covered some of them like Lemonade and Palantir and Snowflake and companies like that. But we really have to buy in to the story. And there is also so much more to cover on SoFi that I haven't been able to go over in this video. And then some stuff that we just don't know yet. It is quite early on. I can't even try their product as it's not available in the UK. So it's difficult for me to have a really high conviction bet at this point. But I really do like what I've seen so far, like I say. Hopefully I can share more information later in another video when necessary, and as the story continues to unfold, I will try and provide more info. Let me know what you think of IPOE and the SoFi merger. Are you buying or are you waiting to find out more? I'm definitely going to be keeping a close eye on it, and I may or may not buy as I start to find out more information in the coming week or so. But if anyone knows anything about SoFi that I've missed, please let me know. And I'd be interested to hear from people who have experience using their products. Anyway, if you enjoyed the video, please be sure to leave a like and subscribe and click that notification bell if you are new to the channel to see more investing and analysis videos such as this one. But until next time, good luck with your investments.